Let's get right into it. If you're running a business as an S-corporation, there's a lot more to your salary than just writing yourself a paycheck. The way you pay yourself can have a huge impact on your finances, your taxes, and even the long-term health of your business. If you own a small business set up as an S-corporation, how you pay yourself is a crucial financial decision. It's not just about taking money out of the business. Your salary is a key factor in how much you'll owe in taxes and how the IRS views your business practices. It's not just about transferring money. Your salary directly impacts your tax bill. The IRS expects you to pay yourself a reasonable salary, and if you don't, you could be setting yourself up for trouble. For 2025, the IRS is watching S-Corp salaries more closely than ever, and mistakes can cost you thousands in back taxes and penalties. The government is cracking down on business owners who try to game the system by paying themselves too little. The key issue is the reasonable salary, the amount the IRS expects you to pay yourself for your actual work. This isn't a random number. It's based on your role, your industry, your experience, and what similar businesses pay for similar work. Think of it as what you'd pay someone else to do your job. If you were hiring a manager to run your business, what would you offer them? That's the kind of logic the IRS uses when they look at your salary. The lower your salary, the less you pay in payroll taxes, but go too low, and you risk an IRS audit. Underpaying yourself might seem like a way to save money, but it can backfire in a big way if you get caught. The IRS uses data analytics to flag businesses paying unusually low salaries. They compare your numbers to industry averages and look for red flags, so it's harder than ever to slip under the radar. As your business grows, the temptation to keep your salary low and take more in distributions increases, but that's risky. The more successful your business becomes, the more attention you'll attract from the IRS if your salary doesn't keep up. Understanding and following the rules is about smart tax planning, not loopholes. Setting the right salary helps you avoid penalties, keeps your business compliant, and ensures you're making the most of your S-Corp benefits. We'll break down how to determine a reasonable salary, what happens if you get it wrong, and how to document your decision. You'll learn the steps to protect yourself and your business from costly mistakes. Get this right, and you'll optimize your taxes, protect your business, and set yourself up for long-term success as an S-Corp owner. So what exactly is an S-Corporation? An S-Corp is a tax election, not a business entity. You form an LLC or C-Corp, then file Form 2553 to be taxed as an S-Corp. The main benefit is how profits are taxed, impacting your personal income. S-Corp status is for small to medium U.S. businesses with no more than 100 shareholders, all of whom must be individuals or certain trusts, and U.S. citizens or residents. The big draw? Tax savings on self-employment taxes. As a sole proprietor or standard LLC, all profits are subject to self-employment tax, 15.3% in 2025. With an S-Corp, you split income into salary, subject to payroll taxes, and distributions, not subject to those taxes. This is the key advantage. S-Corp status makes sense when your business is consistently profitable, usually over $50,000, $60,000 in profit per year. Below that, the extra admin work may not be worth it, but once you're profitable, the tax savings can be substantial. As an S-Corp owner, you have a unique advantage. You can pay yourself in two distinct ways, through a salary and through distributions. Understanding the difference between these two is crucial for maximizing your tax benefits and staying compliant with IRS rules. Your salary is a regular paycheck for the work you do in your business. In this role, you're considered an employee of your own company, and just like any other worker, federal and state taxes are withheld from your paycheck. This means you're paying into Social Security and Medicare, and your income is reported on a W-2 at the end of the year. The S-Corp itself is also responsible for paying its share of payroll taxes on your salary, just as it would for any other employee. This is a key part of remaining compliant with employment tax laws. After you've paid yourself a reasonable salary and covered all business expenses, any remaining profits in the company can be taken out as distributions. These distributions represent your share of the business's success. Distributions are your owner's reward for investing in and growing the business. The big advantage? Distributions aren't subject to self-employment tax or FICA taxes. Only regular income tax applies, which can mean significant tax savings. This is the heart of S-Corp tax savings. By splitting your income between salary and distributions, you can reduce your overall tax burden while still following the rules. Here's how it works. The S-Corp earns profit, pays you a W-2 salary, which is deductible as a business expense, and the remaining profit is available for distributions. This structure is what makes the S-Corp so attractive to many business owners. But remember, you must pay yourself a reasonable salary first. Skipping the salary and only taking distributions is a major IRS violation and can lead to penalties, audits, and back taxes. Think of it this way: your salary compensates you for the work you do, while distributions reward you for your investment and risk as a business owner. It's essential to keep these roles and payments clearly separated in your records to avoid confusion and potential issues with the IRS. Consistent, well-documented payroll practices are not just good business. They're essential for protecting your S-Corp status and your tax savings. Don't blur the lines between salary and distributions. This clear separation is the foundation of S-Corp tax benefits and legal compliance. Get this right, and you'll not only maximize your savings, but you'll also ensure your business stays on the right side of the law. The S-Corp strategy hinges on paying yourself a reasonable salary. The IRS expects you to pay what similar businesses would for your role, considering your experience, duties, and location. Think like a hiring manager. What would you pay someone to do your job, including all the hats you wear? For 2025, the IRS uses data to compare your salary to industry benchmarks. If your salary is far below what's typical, you'll likely be flagged. There's no set formula, but you must document your research and reasoning. Keep records. Salary data, job descriptions, hours worked, and comparisons to similar roles. This documentation is your best defense in an audit. A clear, logical justification can save you stress and money. Let's dive into some real-world numbers to see how S-Corp salary decisions play out in practice. These examples will help you understand the logic behind setting a reasonable salary and the impact it can have on your taxes and compliance. For instance, imagine you run a solo graphic design S-Corp, and your business brings in a $150,000 profit for the year. You're not just designing, you're also managing clients, handling admin, and running the show. According to market data, senior graphic designers typically earn between $70,000 and $90,000 annually, depending on experience and location. Since you're wearing multiple hats, you decide to set your salary at $85,000, a figure that's both competitive and justifiable based on your responsibilities. You'll pay FICA taxes, Social Security, and Medicare on that $85,000 salary, just like any other employee. The remaining $65,000 of your profit is taken as a distribution, which isn't subject to payroll taxes. This move alone can save you nearly $10,000 in payroll taxes for the year, making a big difference in your take-home pay. Remember, you'll still pay regular income tax on the full $150,000, but you've legally reduced your payroll tax burden by splitting your compensation this way. This strategy is completely legal when done correctly, and it's one of the main benefits of the S-Corp structure. Let's look at another scenario. Say you're a real estate agent with $250,000 in profit. After researching local broker salaries, you set your own salary at $120,000, which is in line with what others in your field earn. The remaining $130,000 is taken as a distribution, saving you almost $20,000 in payroll taxes, money you can reinvest or use for personal goals. But here's a cautionary tale. If that same designer tried to pay themselves only $30,000 as salary and took a massive $120,000 as a distribution, the IRS would almost certainly flag this as unreasonable. They'd likely reclassify much of that distribution as salary, resulting in back taxes, penalties, and a lot of stress for the business owner. The lesson here is clear. Use reliable market data, be realistic about your role, and don't get greedy with distributions. The IRS has access to industry salary data and knows what's typical for your profession and region. Always document your reasoning for your salary choice and keep records to support your decision in case you're ever questioned. These examples show how you can maximize your tax savings while staying fully compliant with the law. Striking the right balance between salary and distributions protects both you and your business from unnecessary risk. Don't risk your business by underpaying yourself. Smart, well-documented planning pays off in the long run and keeps you on the right side of the IRS. The biggest risk is paying yourself too little. The IRS will reclassify low distributions as wages, and you'll owe back payroll taxes, penalties, and interest. A small mistake can snowball into a huge debt. Overpaying yourself isn't illegal, but you lose the S-Corp's main tax advantage. More of your income is hit with payroll taxes. Too high a salary can also reduce valuable deductions, like the Qualified Business Income (QBI) deduction. The goal is to find the sweet spot, not too low, not too high. Use market data and your business's specifics to set a fair salary. Document your decision and review it annually. Don't leave money on the table or risk IRS trouble. Smart, balanced planning is key. Protect your business by getting this right. Reasonable salary depends on your industry and your role. For service businesses, consultants, attorneys, accountants, your salary should reflect the value of your expertise and labor. Research what someone with your skills would earn locally. For product-based or asset-heavy businesses, your salary may be a smaller share of profits, reflecting your management and strategy work. Consider where your business's income really comes from: your labor, your team, or your assets. Use multiple data points: salary calculators, job postings, past pay, and hours worked. Build a comprehensive case for your salary. Document everything to show you've been diligent and fair. This is exactly what the IRS wants to see. Certain mistakes are red flags for the IRS. Taking no salary or only distributions is a guaranteed audit trigger. Paying a token salary far below industry norms is just as risky. Inconsistent or lump sum salary payments look suspicious. Pay yourself regularly, like any employee. Never let your salary stay static for years if your business is growing. Huge distributions compared to a low salary will draw scrutiny. The IRS expects your compensation to reflect your role and business performance. Keep your salary to distribution ratio reasonable and adjust as your business evolves. A balanced, well-documented approach keeps you off the IRS radar. To wrap up, managing your S-Corp salary in 2025 comes down to a few best practices. Always pay yourself a reasonable, well-researched salary. Document your process, job description, hours, salary data, and your reasoning. Update this annually, especially if your role or business changes. Use a payroll service to pay yourself consistently and keep clean records. Keep salary and distribution separate in your accounting. Don't make lump sum or irregular payments. When in doubt, consult a CPA or tax advisor who specializes in small businesses. Their guidance can save you money and stress. Paying yourself right isn't just about taxes, it's about building a strong, compliant business. Get it right and you'll sleep better at night. Smart planning today protects your future.